Welcome to the deep dive. Today, we're jumping into international finance, specifically Luxembourg.
Right, a key hub.
Exactly. We're looking at the backbone, really, of a lot of global asset management, the Luxembourg Holding Company. And this isn't just, a tax minimization thing. It's more about strategic setup, efficiency, legal stability for assets held globally.
That's absolutely right. If you look at why entrepreneurs, PE firms, VCs, even family offices choose Luxembourg, it consistently comes up as this trusted jurisdiction.
Trusted, okay.
Yeah, and it really boils down to three things: a stable, predictable legal system, a competitive tax framework, which is very structured, and crucially, its global connectivity through tax treaties.
Okay, let's break that down a bit for you listening. A holding company in this context.
Yeah?
What's its main job? Is it just a passive shell?
No, not usually. The core mission is really active consolidation and management. It's designed specifically to hold and manage what they call financial participations.
Financial participations. So shares, bonds.
Shares, bonds, interest in investment funds, private equity stakes, and very often intellectual property rights, too.
Ah, IP. Okay.
Yeah. The aim is to gather these maybe scattered global holdings under one roof, makes management simpler, and yes, helps optimize the tax side efficiently.
Got it. And our research points straight to two main structures here, the SOPARFI and the SPF.
The big two.
Terms like two sides of the same Luxembourg coin almost.
They really are. And honestly, understanding the difference between the SOPARFI and the SPF, that's pretty much the whole point of this deep dive today.
Okay.
Because while they're both holding vehicles, they serve, well, vastly different needs. The SOPARFI is your flexible commercial workhorse.
Right, for business activities.
Exactly, activity financing. Whereas the SPF, that's more like a pure private wealth shield. Very passive, focused on family assets, different investors, different tools.
Okay, let's dive into the SOPARFI first then. The Société de Participation Financière sounds like the flagship, the most common one.
It absolutely is the most widely used. It's the workhorse, like you said, and its versatility. That comes directly from the fact that it's considered a fully commercial company.
Fully commercial. That's the key difference right there.
It's fundamental. It's not just sitting there passively. And you can set it up either as an SA, a public limited company, or an SARL, which is the private limited liability company.
So even there, you've got choices.
Yeah.
Depending on if you need outside investors or want to keep it tightly held.
Precisely. Flexibility in governance, capital structure right from the start.
So being commercial means it can do more than just hold stock certificates. What kinds of activities are we talking about?
Oh, quite a range. Obviously, it holds equity stakes. But beyond that, a SOPARFI is very often involved in intergroup financing.
Lending money within the corporate family.
Exactly, lending to subsidiaries across the globe. It can also actively manage intellectual property, receive royalties from licensing that IP, and it can even conduct certain sort of ancillary operational activities related to its holdings. It's an active piece of the puzzle in a multinational group strategy.
Now, if it's a commercial entity, it must be, well, taxable on its profits generally, right?
Correct. It's fully subject to Luxembourg corporate income tax and municipal business tax on its operational profits.
But this is where the magic happens, right? The participation exemption.
Right.
How does that work if it's already taxable?
Yeah, it's not really a loophole. Think of it more as a sophisticated filter. The SOPARFI pays tax on its regular business income. But for specific qualifying income dividends it receives from its holdings or capital gains when it sells them, Luxembourg applies rules to prevent that income being taxed twice.
Ah, avoiding double taxation. The holy grail of international structuring.
Pretty much. It leverages domestic rules, EU directives like the parent subsidiary directive, and that big treaty network we mentioned.
Okay, so what are the specifics? What qualifies for this 100% exemption on, say, dividends?
There are clear conditions. It's designed to encourage strategic, long-term investment, not quick flips. You get a 100% exemption on dividends if you meet certain thresholds.
Okay, like what?
Either you need to hold at least a 10% stake in the subsidiary paying the dividend.
10%? Okay.
Or, if it's less than 10%, the acquisition cost of that participation has to be at least 1.2 million.
1.2 million euros. And there's a time element, too.
Yes, that's crucial. You need to have held or commit to hold that participation for at least 12 continuous months.
Got it. So the 12 months, the 10% or 1.2 million, that's basically signaling this is a real substantive investment, not just parking cash for a week.
Exactly. It's about demonstrating substance and commitment. That's vital for the whole structure's legitimacy in the eyes of tax authorities, both in Luxembourg and abroad.
And does this efficiency also apply when the SOPARFI actually sells the investment? Capital gains.
Yes, it does. There's also an exemption for capital gains realized on the sale of qualifying participations. The thresholds are slightly different, though.
How so?
It's still a 10% holding requirement, or alternatively, an acquisition cost of at least 6 million.
6 million euros for capital gains. Higher bar.
A bit higher, yes. But again, held for that minimum 12-month period. This allows groups to, reorganize their structure, sell off a subsidiary perhaps, without triggering immediate tax on the gain within the SOPARFI itself. Very useful for M&A.
Makes sense. And you mentioned IP earlier. There was something about an exemption there, too.
That's right. For qualifying intellectual property income, things like royalties from patents, trademarks, software developed, there's a potential 80% exemption on the net income.
80%, that's substantial.
It is. It makes the SOPARFI a very attractive vehicle for centralizing a group's global IP assets, managing them, and handling the licensing from Luxembourg. Again, leveraging that commercial nature.
Okay, but if it's commercial and it gets access to all these treaties and exemptions, Luxembourg must make sure it's a real operation, right? Not just a brass plate on a door.
Oh, absolutely. This is the whole substance requirement debate. It's critical. Because the SOPARFI benefits from these valuable treaties, it must demonstrate genuine economic substance in Luxembourg.
And what does that mean in practice? Like real people, real office?
It means having things like qualified local directors, or at least directors who are genuinely managing the company from Luxembourg. It needs a registered office, appropriate accounting records maintained locally, holding board meetings physically in Luxembourg. You need to show decisions are being made there.
So if you fail that substance test,
you risk losing access to those treaty benefits, which kind of defeats the purpose. So substance isn't optional, it's essential.
okay, so the SOPARFI, active, commercial, flexible treaty access, but needs substance. The Swiss Army knife, as you said.
A good analogy.
Now let's pivot to the other side. The SPF, Société de Gestion de Patrimoine Familial. This sounds much quieter, more restricted.
It is. Deliberately so. Think of it as the dedicated vehicle purely for private wealth management. It's actually the modern successor to a very old, famous Luxembourg regime, the Holding, 1929. The SPF was created to provide a cleaner, more specific tool for passive family wealth.
Passive is the key word here. What are the hard limits? What can an SPF absolutely not do?
Right. The boundaries are very strict. An SPF is limited only to acquiring, holding, and managing financial assets. Passively.
Financial assets meaning?
Stocks, bonds, cash, fund units, basically liquid or semi-liquid financial instruments.
And the big no.
The big no is any kind of commercial activity. No trading, no providing services, no holding operational subsidiaries, no intragroup financing. And critically, it generally can't hold things like real estate directly or intellectual property.
So no running a business through it, not even managing IP royalties like the SOPARFI.
Absolutely not. Its sole purpose is to be a secure, passive vault for a family's financial investments.
And who gets the key to this vault? Can anyone set one up?
No, the ownership is also restricted. Eligible shareholders are basically private individuals managing their own wealth.
Just individuals.
Or certain structures clearly acting on behalf of private individuals or families, think trusts, private foundations sometimes, but definitely not institutional investors, corporations, or the general public. It's walled off for private use.
Okay. The SOPARFI uses exemptions to become tax efficient, even though it's taxable. How does the SPF work tax-wise, given all these restrictions?
The SPF takes a totally different approach. Because it accepts these strict limitations on activity and ownership, it gets rewarded with, well, almost complete tax exemption.
Complete exemption. From what?
It's exempt from Luxembourg corporate income tax, exempt from municipal business tax, and exempt from the annual net wealth tax.
Wow. Okay, so what does it pay? There must be some fee.
There is, but it's minimal. The SPF is subject only to an annual subscription tax, the taxe d'abonnement. It's calculated at 0.25% on the value of its paid-up capital plus any share premiums.
0.25% annually. That's it.
That's essentially it. For purely passive wealth holding, that comprehensive exemption is obviously a huge draw. Simplicity and very low tax leakage.
All right, I have to ask the slightly skeptical question here. If it pays almost nothing, and it's only for private individuals, how does Luxembourg stop it being misused? Isn't the lack of, say, commercial supervision a risk?
That's a really important point, and the answer lies in how it's regulated or perhaps how it's not regulated in one specific way. The SOPARFI, because it's commercial, potentially deals with third parties, finances things. It falls under the supervision of the CSSF.
The main financial regulator in Luxembourg.
Correct. The Commission de Surveillance du Secteur Financier. They keep an eye on commercial financial activities. The SPF, however, is not supervised by the CSSF.
It completely avoids the financial regulator.
Yes. The rationale is that because it's strictly limited to passive management of private wealth, owned only by individuals, and cannot engage in commercial or financial services activities, it doesn't pose the same systemic risks that warrant CSSF oversight.
But that doesn't mean it's a black box, right? There must be some checks.
Oh, absolutely. While it avoids CSSF market supervision, it is still a Luxembourg company. It's fully subject to all the standard legal requirements, including, very importantly, comprehensive anti-money laundering, AML, and know your customer KYC obligations.
Ah, okay. So AML KYC still applies fully.
Yes. Financial intermediaries setting up or servicing SPFs have strict duties there. The distinction is supervision of market activity versus fundamental legal and compliance checks.
That clarifies it nicely. So the users here are definitely not the big multinationals using SOPARFIs. Who are the typical SPF clients?
Exactly. You see SPFs used heavily by, say, entrepreneur families who've maybe sold their main operating business and now need a simple passive vehicle to reinvest the proceeds globally.
Makes sense.
Also used by high net worth individuals for straightforward succession planning, consolidating assets for the next generation, and by family offices that need a central hub for a diverse global financial portfolio where they don't need the commercial flexibility of a SOPARFI. Simplicity and that near total tax shield are the goals.
Okay, let's zoom out again to the global perspective. Both these structures, SOPARFI and SPF, seem really designed for international assets. You mentioned earlier over 80% of SOPARFIs hold foreign assets.
Yeah, that figure really highlights Luxembourg's role. It's not just a European thing, it's a global platform.
And what kind of assets are typically held through these Luxembourg structures from abroad?
All sorts. Equity in operating companies across Europe, Asia, the Americas, units in investment funds globally, shares in private equity or VC funds located outside the EU, even stakes in non-EU businesses. The structure acts as the legal and tax interface.
And the real engine driving this global reach is that network of double tax treaties you mentioned.
That's probably the single biggest practical advantage for international investors. Luxembourg has worked hard to build one of the world's most extensive networks of double tax agreements.
And for the listener, how does that translate into a tangible benefit?
It means that when dividends, interest, or royalties flow from a company in, say, country X into your Luxembourg Holding company, that treaty between Luxembourg and country X can often significantly reduce or even eliminate the withholding taxes that country X would normally charge.
So less tax leakage on the way into the holding company.
Exactly. And it also usually ensures efficient repatriation of profits out of Luxembourg later on, again, minimizing tax friction. It provides predictable, treaty-protected pathways for cash flow. That predictability is gold for long-term planning.
So if we bring this all together, who are the main players using these structures? We've touched on a few, but let's recap the big categories.
Sure. So private equity and venture capital firms are huge users, almost exclusively of the SOPAR.
Because they need that commercial flexibility.
Yes, they need to potentially set up acquisition platforms, provide funding to their portfolio companies, maybe hold some IP, and critically, they rely heavily on the capital gains exemption when they exit their investments.
Makes perfect sense. Then multinational corporations.
They use SOPARFIs extensively too, often for centralizing treasury functions, managing intergroup financing as we discussed, holding key regional subsidiaries, or facilitating group reorganizations tax efficiently.
Okay. What about institutional investors or real estate?
Institutional investors like pension funds might use SOPARFIs. Real estate investors often use them too, sometimes holding property directly if allowed, or more commonly holding shares in specialized real estate companies or funds.
And finally, the families and entrepreneurs.
That's where you see both. Wealthy families and entrepreneurs might use a SOPARFI if they still have active business elements or complex financing needs. But if they're moving purely into passive wealth preservation and succession planning, the SPF becomes the much more logical tax-sheltered choice.
This has been really helpful in mapping out the landscape. So to boil it down for everyone listening, the SOPARFI is your go-to for commercial flexibility, handling financing, managing IP, and it gets its tax efficiency through that participation exemption filter. provided you meet the substance rules.
Right. Active, flexible, commercially oriented.
Whereas the SPF is the dedicated private wealth shield. It offers almost complete tax exemption, but demands you stay strictly within passive investment boundaries with no commercial activity, and it's reserved for private individuals and families.
Passive, restricted, highly tax sheltered. That's the trade-off.
So if we think bigger picture here, Luxembourg's strength isn't just low taxes, is it? It seems to be about the stability and the clarity of the choice it offers.
I think that's exactly right. The legal framework is stable, predictable, and having these two distinct vehicles, SOPARFI and SPF, forces a very clear strategic decision.
A decision about what you really need the structure for.
Precisely. You have to choose. Do you need the commercial flexibility, the ability to finance, to own active assets like IP, even if it means dealing with substance rules and the participation exemption framework? That's the SOPARFI path. Or is your priority absolute tax sheltering for purely passive financial wealth, accepting the tight restrictions on activity and ownership? That's the SPF path.
Yeah.
It forces you, the investor, to really define the purpose and the intended ownership of your assets up front.
Which leads to a really interesting final thought for you to ponder. When you're structuring significant wealth, especially across borders, how do you weigh that balance, the value of commercial options and flexibility today versus the benefit of maximizing pure, restricted, tax-exempt preservation for tomorrow?
That's the fundamental strategic question, and how you answer it really shapes your entire approach to managing and growing your capital long term.